As the presidential election is fast approaching, here are some ways elections have affected the bond market. And firstly, a question you may have is, what is a bond? A bond is a loan taken out by a company, and instead of going to the bank, the company gets the money from investors who buy its bonds, which allows them to gain more capital. The company then pays an interest yield, which is an annual interest rate paid out to investors. Bonds do not get impacted by company performance. However, the company must stay afloat to pay the bonds with interest back to the investors. Bonds are one of the safest ways to enter the investment world, as it is a long-term investment you can make and then forget about. It provides a set return that may be small but can create a wealthy future. During presidential elections, the stock market tends to be unstable in the days leading up to the big day. This leaves long-term bonds as a very conservative and safe investment. According to stock market researcher Yale Hirsch, who published the first edition of the Stock Trader's Almanac in 1967, he deemed a theory called presidential cycle theory. This theory is that a president's market performance does the worst in the first year, then peaks in their third year before declining in their fourth year. This affects the bond market as well as the stock market. Republicans, as seen in the 2016 election, typically lower taxes, as Trump did with the Tax Cut and Job Act in 2017. These lowered taxes also reducing the bonds' return yields, and on the other hand, Democrats in 2021, represented by Joe Biden, affected raised corporate taxes and increased government spending. This in turn raised inflation and increased bonds' return yields. An example of how the bond market increased after an election was back in 2016. A week after the election, the benchmark 10-year Treasury went from a yield of 1.8 to 2.3%. The 30-year bond yield crossed the 3% level that following Monday. This increased the cost for the government to issue bonds and borrow money, with higher interest rates for the following years after the 2016 election. Bond yields increase when there are high taxes and inflation is prominent. Investors want higher returns since higher taxes will take away some of their returns. Ahead of this year's election, the Federal Reserve has hinted at possibly lowering the interest rates. This would lower bond yields as the interest generated by the bonds over time would be less. Bond prices would also rise since the demand for them is increased with interest rates are lowered. It remains to be seen exactly how the market reacts to this year's election, but the Federal Reserve's decision on interest rates will surely play a big role in the bond market.